to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where Treasury professionals learn and share the information that matters most.
Hello and a warm welcome to the Open Treasury podcast from CTM File. I am Pushpendra Mehta, Executive Writer for CTM File. My guest for today is Craig Jeffery, Managing Partner and Strategic Treasurer. Welcome back to the Open Treasury podcast, Craig.
Thanks, Push. It is good to talk about all things Treasury and economics.
Great. Let's start a review of the latest Treasury news and developments. We'll focus on a short list of top items that we'll discuss. We'll cover 3 sections of headlines. The first one revolves around the world economy and reports of a looming recession. The second section focuses on security and fraud prevention. And the third section covers open banking. Craig, let's get started with the first section, shall we? This includes 2 articles that indicate the world is careening towards a recession. The first story is a report by Moody's Investor Services that assesses the global economic impact of the Ukraine war. And the second story is the published article on CTM File titled "The World May Be Heading into a Recession." Russia's invasion of Ukraine is causing a rise in commodity prices and supply shocks that will lead to higher interest rates and slower growth, increasing risks for banks and other parts of the finance sector, predicts Moody's. The GDP growth for the G20 economies is expected to slow to 3.6% in 2022 from an earlier forecast of 4.3% in February. That will further slow to 3% in 2023, according to Moody's. Craig, my concern is that surging commodity prices, supply chain bottlenecks, soaring inflation, and financial markets volatility will result in a liquidity squeeze, higher corporate default rates, risks, and bank write-off. Craig, with reference to Moody's report, do you think banks, global insurers, asset managers, and fintech companies are at the highest risk because of the projected global economic contraction and the conflict?
I think quite a few people expect some challenges in the financial sector for various reasons. Some of the statistics that you mentioned from Moody's show a general slowing, and that has some ripple effects or trail-on impacts to those sectors. Part of the discussion there has to do with from that article, the 4 channels of risk transmission that they mention, from commodity price to security and operational risk. Some of those are not as common on the economic side, so concerns on the cyber risk side have really been spiking, and those have a significant cost and potential impact to those sectors as well. That, coupled with the liquidity tightening and market volatility, according to Moody's, bears direct weight on that industry. Another factor there, Push, that same article quotes Deutsche Bank about their bank having forecasted the U.S. economy. They expect it to enter a recession over the coming months, and they highlight 2 of those particular issues. One was the war in Ukraine, the Russia attack and continued attack on Ukraine, and they mentioned the buildup of momentum in U.S. and European inflation. U.S. inflation rates for March just came in at 8.5%. This is unheard of in the last decade and a half or 2 decades, and it reflects back to a much earlier times, multiple decades ago. This was attributed to cause their forecast to drop down from a global growth impact. So Deutsche Bank's predicting a recession in the U.S. and a growth recession in the Euro area within the next 2 years. So they're negative on it, perhaps the most negative of some of the major sources for that. So there's a number of factors coming together that put some downward pressure there for potential recession.
The second story in this section is a continuation of what you just mentioned, is that the world may be heading into a recession. Craig, a recession in the US is virtually inevitable, according to Bill Dudley, the former president of the Federal Reserve Bank of New York. Like Moody and Deutsche Bank, Goldman Sachs believes that the US recession is again going to happen, and the odds they predict are as high as 35%. Europe is on the verge of recession due to the Ukraine conflict. The Middle East, North and East Africa, which relies on Russian and Ukrainian vegetable oil and grain supplies, are being adversely affected because of the holdup on food supplies coming from Russia and Ukraine, which will fuel food inflation. Latin America is experiencing an economic downturn. The World Bank says that Asia is going to drag, and there will be a slowdown there as well. And as if this is not enough, we have China, China's COVID wave and the lockdowns. Those are also posing significant risks to global economic growth. And then you have central banks that are trying to tighten monetary policy around the world, again, to tame inflation. And last but not the least, the intensity of the second phase of the Ukrainian war and the resultant punitive sanctions, more of which may be imposed against Russia. Given all of this, in the light of these developments, Craig, as an expert on treasury, what would your advice be to treasurers in terms of preparing for the recession or the negative economic growth?
What are some of the issues causing those downturns? When you look in Latin America, they've had more severe COVID lockdowns than we have in North America, particularly the U.S. and most of the U.S. I mean, there's quite a variation within the U.S. It's like a country of countries in terms of response. The restriction of movement, restriction of activity lowers the economic output, puts people in challenging positions. And same thing with some of the Asian countries, including China, in terms of some regions where they've had COVID increases in their responses, very hard lockdown, not like what we typically see in Western countries, but very, very severe. And since they're such a factor in the supply chain, it makes a difference. So I think what should corporate treasurers do and look at? They should be always following their existing risk framework. As they looked at their risk framework, what's their risk attitude, their perspective on it, everything from earlier captured risk capacity and then a more narrow risk appetite. What are they really prepared to accept across these different dimensions of risk? It could be cash flow, change in earnings. We usually think about things in terms of foreign exchange volatility, the price shifts on commodities, interest rate changes. I think most people are factoring in quite an increase in interest rates over the next year and a half. So I think when we look at those exposures, that shouldn't necessarily change the framework. But if you think about operating your risk management within an envelope, you've got areas to move up or down, left or right, whether it's with counterparties, with how long you go out on your borrowings or your investments, or what are you doing, from your hedging policy. You still have to operate within those. But if you move around like you would within an envelope, that's still your protective range. There might be some adjustments to continue to bring your risk exposures in line with your risk appetite, your ability to handle and manage that. And there may be some areas where you're saying there's certain risks that will go outside of our capacity in certain areas, and that would obviously require a more extreme adjustment. But, in terms of the expectations, look at the expectations in these different areas: interest rate, foreign currency. Notice what is changing and how you may move within the envelope. Now, if you don't have a risk framework down to different individual risk management policies, this is a very good time to get those put out in a formal manner so that you have a way to operate. But how do we move within that envelope? It might be when things get risky, you might pull things in shorter, like on investments. You don't put stuff out 3 months or 6 months. If it's very unsecure, you might pull it into a week or just overnight. Same thing on whether it's borrowing. You may say interest rates are going up. We want to push out farther to secure more funding. If you're concerned about some liquidity event happening or a freeze up of the markets, not that anybody ever predicts that, just being a little more diverse and extending those. So playing within that envelope across those dimensions of risk, particularly foreign currency, commodity price, and interest rates, it makes sense. So all these situations involve, having the all hands on deck, talking about what's going on. Where are you in your envelope? Where do you need to move, if you need to move, and just being alert to it. The second part of that is not just what you do financially, but how you communicate it to the organization. Not everyone's risk management oriented, And there can be this whipsaw effect of someone being concerned about certain events happening and why are we not covered? Why are we covered at this level? Communicating early, communicating proactively is far better than reactive and defensive communication to why didn't you anticipate X or Y from occurring or some fallout. And you mentioned a number of items from food prices to general economic shifts and increase in price that has a very large business impact. So those are all the things that the treasurer needs to consider.
Excellent analysis. Moving forward to the second section for today, which is about security and fraud prevention, and you touched upon cyber attacks a few minutes ago. There's a cyber attack every 39 seconds. Given that context, the first story here within this section pertains to NatWest Group partnering with Bottomline Technologies to reduce authorized push payment or APP fraud in the UK using Bottomline's confirmation of payee solutions. Reports have indicated a significant increase in APP fraud in the UK's financial services sector. Craig, what are your thoughts on this partnership?
Well, I think we're going to see more of these types of partnerships happening, not necessarily just with Bottomline or NatWest, of course, but with different institutions. A couple things. One, security is a top concern. We see that in strategic treasurers research. We see that through other research. I was just at one of the $1 trillion banks the other day, this week, talking about some of their research, and they've clearly seen that's moved to the top position in some of how they're looking at things, a three-year trend moving to the top position. So security is top of mind, and there's a lot of reasons for that. The second element of this story push is the power of networks. A network like, in this case, the Bottomline's network, being able to, have this large database of companies and organizations allows that confirmation process to be outsourced to a central area, a network, if you will. So the power of a network is how big is it? What can you do with it? And this is an example of how you can leverage the power of networks and community to provide better protection, as an example, not just ease or efficiency, but better protection. And so this collaboration, if you will, makes tremendous sense. And you think about how banks and fintechs used to be viewed as competitors. One's going to displace the other. But what we're really seeing is they're being put together in combinations, leveraging each other's strengths, creating a different view of fintechs and banks, much more collaboration to address some of these really difficult issues in a very effective way. So, I think this is there'll be a lot more to come of this type of activity in the coming months and years.
Craig, the next story that caught my attention is about IBM's launch of a new generation mainframe with AI or artificial intelligence built into the chip to enable financial firms to conduct fraud analysis of transactions in real time. Payment firms have two concerns when presented with a payment: preventing fraud, and the second is turning down legitimate transactions due to false positives. This I thought was particularly interesting. IBM, as we all know, the IBM mainframes, they play a leading role in the financial services industry. So, Craig, do you think IBM's AI adoption to a chip will be a game changer in the fraud prevention analysis landscape?
In terms of saying it's a game changer, I'll let other analysts make those types of comments, whether it's a game changer. Is this part of an ongoing acceleration to use AI for anomaly detection in the fight against fraud? It certainly is. Everything's moving in one direction. The ability to track anomalies for fraud in particular, not just errors and quality control, but for fraud, is a massive play and a massive need for banks, any payment provider. So this is certainly in that heavy stream. I mean, the current is all moving in that direction. And you mentioned the type 1 and type 2 errors, right? You let a payment go through that's fraudulent, or you block a payment that's legitimate. And so the leveraging AI to help sift through what's normal and what's not allows much greater scale, much greater speed to learn from, to help address these issues and avoid the type 1 and type 2 errors. Both are bad. One is a loss of money, and the other is a loss of confidence and, perhaps a bit of a reputation risk, but also some frustration. So this is all in the vein of doing that. And so we see AI and ML very heavy in this direction. And so this is a good story on that front.
Excellent. The penultimate news story for today is about increasing competition in open banking, as Wells Fargo and Bank of America are reported to be among major banks considering plans to enable Zelle, US-based digital payments company for online retail payments at large merchants. With growing Zelle adoption, Insider Intelligence forecasts that the number of users is expected to increase by 13.8% year on year to reach 61.6 million in 2022. Craig, my question to you is, will Zelle cannibalize the revenue banks earn from card payments, or do you think card payments will continue to dominate the online retail payments business?
Yeah, Push, I don't know if those are opposite statements. I don't know that necessarily but I do expect, and I think we expect in our conversations, Zelle to continue to expand more than just person to person. And the adoption rate of Zelle is astounding. A lot of P2P adoption rates are growing very rapidly, very easy, frictionless, almost instantaneous, very easy to do for smaller dollar transactions. I mean, you're not buying a car for them. This expansion as another payment method is probably likely. I mean, the Juniper Research estimated a 29x growth in open banking. So their estimate was the value of global banking transactions facilitated by open banking. So this embedded connected world increasing from about 4 billion last year in 2021 to over 116 billion by 2026. So in a 5-year period, they're expecting 29x growth. It's going to be large. We'll have to see if that's if their estimate is close or maybe a bit exuberant. But we see heavy growth in some of these methods and expect that to be the case. Now, there is in this same article, it's not like everything's moving in one direction. There's some caution winds. Of the $1 trillion banks, at least one of them is like, hey, this may not be the right time. There's other fraud issues. And so there's some hesitation on the part of at least $1 trillion bank. That's some significant headwinds, despite more people thinking that it needs to move ahead as an option. I think we're going to see more of this, and there's going to be a lot of players in the space that continue to grow. So this open banking and competition in open banking is going to continue to be very, very challenging, from Apple to all different payment methods, including Zelle. We're going to see a lot of significant churn growth, and there'll be some fallout from it too.
Finally, Craig, what is your choice for the biggest or the most important story of the past week, and why?
There was an awful lot of stories this past week about crypto, and we didn't talk about any of those. There was just so many items coming out, from regulations to new activity to new partnerships. Even if we had talked about those wouldn't have made my list. My guess as I look at this, the recession issue is probably the biggest. We've had, your story, a number of other items that are coming out. The headwinds on inflation are large, and the potential of a recession, I think you refer to it as looming, are probably the most worthy of attention in terms of what this means, from a financial perspective. What do we do from it? And so whether that's the growth or the growth of that risk from the attack of Russia on the Ukraine, the impact on the supply chain, overall inflation, central bank activity, there's a lot of items there that are worthy of paying attention, relooking at our risk. So that's my number one article, is the overall economic.
I would concur with you, because given the interconnectedness and dependence of nations, businesses, and consumers across the world, the recession story fuels economic uncertainty, stokes inflation, and worsens the global food crisis, all of which have ramifications on corporates and banks. Besides the humanitarian ramifications, all of these factors, to my mind, will have a spillover effect and reverberate across the world. So I concur with you that the world is heading into a recession article on CTM File would be my choice of the week too. Thank you for joining us in this edition of Open Treasury, Craig. Thank you to our audience as well. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.